Hello everyone, welcome back to our weekly lecture videos. In this video, I'm going to start chapter 11, Risk and Return. This chapter continues the discussion we began in the previous chapter. We have seen in the previous chapter that some investments have greater risk than others. So in this chapter, we will begin to drill down a bit to investigate one of the most important fundamental problems in finance. What is risk, right? What we will learn is that the risk is not always what it seems, and the reward for bearing risk is more subtle than we have indicated so far. Okay, in the previous chapter, we learned some important lessons from capital market. Most importantly, there is a reward on average for bearing risk, which we called risk premium. The second lesson is that the risk premium is greater for riskier investment. So in this chapter, we explore the economic and managerial implication of this basic idea. Thus far, we have concentrated mainly on the return behavior of a few large portfolios. We need to expand our consideration to include individual assets. Specifically, we have two tasks to accomplish. The first one is we have to define risk and discuss how to measure it. And second, we must then quantify the relationship between asset risk and its required return. Okay. So as usual, we have several learning objectives. We will learn how to calculate expected returns, also expected risk, and we will see the impact of diversification, and relatedly systematic risk principle will come in the picture. And towards the end, we will talk about the security market line and risk return trade-off. So in this video, I will mostly be talking about expected return and risk. Okay. So in the previous chapter, we discussed how to calculate average return and variance using historical data, right? We now begin to discuss how to analyze returns and variances when information we have concerns possible future returns and their probabilities. We start with a straightforward case. Consider a single period of time, 1 year. We have two firms, Emo and QE. And they have these characteristics. There's Emo's expected return is 25% in the coming year, and QE's expected return is 20%. Okay. In a situation like this, one could ask a question that why invest in one share when the expectation is that another will do better, right? For example, QE has an expected return of 25%, right? Now, this return could even be higher than that, okay? Suppose the economy has two possible states, which are boom and recession. In the case of boom, we think the shares in Emo will have a 70% return. And if the economy enters a recession, we think that return will go down to minus 20%. In this case, we say that there are two states of the economy, which means that there are two alternative possibilities, okay? This setup is oversimplified, of course, but it allows us to illustrate some key ideas without a lot of computation. Suppose we think a boom and recession are equally likely to happen for a 50-50 chance. Now, we can explain this situation in the following table, okay? So look that the recession and boom has a 50-50 chance, okay? Emo's return will range from minus 20% to plus 70% in these two situations, and Q is positive 30% to positive 10%, okay? Obviously, if you buy one of these shares, say QE, what you earn in any particular year depends on what the economy does during that year. However, suppose the possibilities stay the same through the time. If you hold QE a number of years, you will earn 30% about half of the time and 10% other half. In that case, the expected return will be somewhat in between 30 and 10%. Okay, so how do we calculate this expected return? So we calculate expected return. We actually incorporate all the possibilities, all the probabilities, and their corresponding return, and we sum them up. Okay, so if I go into our previous slide, so you can see that expected means average if the process is repeated many times. So this is how we calculate expected return. You see that sum of the probability and the corresponding return. So since in the example that I just gave, we have two situations. So each has a probability and its corresponding return. So we multiply them and then we sum them up and we get the expected return. Okay. So you can see that expected return of QE is 20% and expected return of IMO is 25%. Considering for QE, there is 50% chance the return will be 30% and there is 50% chance that the return will be 10%. So expected return is 20%. So as I mentioned previously, that if we plan to hold it for some time, we get in some of the periods we get 30% and some of the periods we get 10%. So as we average them out, our expected return is 20%, right? And if risk-free rate is 8%, you can see that risk premium for QE is 12%. That means we are earning 10% in excess of the risk-free rate. Okay, so this is how we calculate expected return. So if we have different possibilities, each possibility is multiplied with the corresponding return and summing them up. Now, how do we calculate variance or a standard deviation? To calculate the variance of the returns on our two shares that we have seen in the previous slide, what we do is we first determine the squared deviations from the expected return, and we then multiply each possible squared deviation by its probability. We add them up and we get the variance. Okay, so the concept of the standard deviation is same what we have learned in the previous chapter. So it measures the variability of returns. Okay, variability of returns from a benchmark, which is an expected return. So as I mentioned that, first of all, we find out the deviations. Deviations means individual returns, how it deviates from expected return. We square them and then multiply with the probability. Okay, sum them up, so we get the variance. And as we square root the variance, we get standard deviation. So you can see this is the information that we had already. So what we do is, so first of all, we calculate the deviation. You remember that our expected return was 20%. So these are the expected returns. And individual possible return was 30%. So that's the deviation. Individual possible returns minus expected return is squared and multiplied by the corresponding probability. Same thing we do here. And we see that our standard deviation is 1%. And sorry, variance is 1%, and the variance of MO is 20%, and the standard deviation is 10 and 45% respectively. So you see that as I also previously discussed this point in the last chapter, that the variance or standard deviation of an investment individually doesn't necessarily indicate too much, doesn't necessarily indicate that it's more risky or less risky. However, it obviously provides a basis for comparison. For example, QE has a standard deviation of 10% and IMO has a standard deviation of 45%. You remember we asked this question previously, that if expected return of QE is 20% and expected return of IMO is 25%, we raised this question that why someone will invest in QE with a lower expected return while we know that expected return of IMO is higher. However, you can see that although IMO has a higher expected return, its riskiness is also pretty much high. So you see that it's more than 4 times of the standard deviation of QE. So which means that IMO's expected return is higher, and so is its standard deviation, and so it's its risk. As a result, some investor might want to invest in QE. They're happy with the lower expected return as it has less risk. Okay, so this is how we compare the riskiness of investment, and we compare them to decide that whether we should accept an investment compared to another. Okay, so that's the end of this video, our discussion on expected return and risk. So we will continue to discuss this expected return and risk in a portfolio scenario, and we'll bring up the concept of diversification and systematic risk in the coming videos. Thank you very much.